Welcome to our Mindful Moments webinar. My name is Michael Matonzi. Just some housekeeping. We applied for Continuous Professional Development or CPD points. It's important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of November and receive your CPD points. The CPD certificates will be emailed to you during December 2023. Please also feel free to ask questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. You will also find more information about our speakers under the Speaker tab on the top menu bar, or if you scroll down. You can also download the PDF presentations as well. Please engage with our speakers and enjoy the event. First up is Sanisha Pakrisamy, our economist, who will highlight the economic resilience shown in the global economy.
Thank you, Mike. Hello, everyone, and thank you for joining us today. In the wake of overlapping social and economic crises that created an enormous dislocation in markets, the economy made a much stronger and faster recovery than anticipated. Signs of progress have been undeniable as the world economy steadily emerges from the COVID-19 health crisis and Russia's incursion into Ukraine. Supply chain disruptions have largely normalized back to pre-pandemic levels. Global inflation pressures are easing, and labor markets are surprisingly strong. Economic activity and corporate earnings have proven far more resilient in the face of higher interest rates and rising living expenses. Markets have questioned the surprising resilience of the economy and labor markets given the sharpest pace of interest rate tightening that we have seen in more than 40 years. American economist and statistician Milton Friedman's long and variable lags theory partly explains why we have yet to see the full economic impact of prior interest rate hikes, given the traditional 12 to 18-month delay in the time it takes changes in monetary policy to affect aggregate demand. Although markets initially assumed the conventional lag would have shortened given the contraction in central bank balance sheets, this has not been the case. Secondly, pandemic savings pots have kept the economy afloat in spite of tighter policy. Outside of the United States, surplus household savings remain healthy and continue to provide support to ongoing economic recoveries. Finally, substantial fiscal support has differentiated the impact on growth in this tightening cycle. Project Syndicate calculates that close on $3 trillion in interest was paid on bank reserves since 2008, providing a significant channel of fiscal support to the private sector at a time when interest rates were rising. While the integrity of systemically important bank balance sheets and wholesale funding markets are healthier, historic precedent shows us that there is usually a delay in the reaction function of risky asset markets. As such, there is a non-negligible chance that the complacency penciled into global equity markets may yet be challenged. These relatively healthy economic conditions have given rise to the notion of a Goldilocks scenario, denoting not too hot and not too cold investing conditions. A few months ago, the market was preparing for more interest rate hikes and a well-telegraphed recession to prompt the start of a U.S. Federal Reserve easing cycle in the second half of this year already. However, since then, economic data releases have held up well. Jobs figures in the U.S., although slowing, remained bright, suggesting that the economy was relatively successful in stomaching the surge in interest rates since the start of the year. This left the consensus rapidly building up for a scenario of no more interest rate hikes and no recession at all. Nevertheless, announcements by Saudi Arabia and Russia that they would extend oil supply cuts and the devastating conflict between Israel and Palestine have reawakened concerns that inflation, though temporarily subdued, still lurks. An unsettling combination of rising oil prices, expectations of higher for longer interest rates in the US and Europe, and sluggish Chinese economic activity are stirring fears in financial markets. Although the year-to-date performance of the US equity market at face value may seem solid, closer inspection reveals that this can be attributed solely to a handful of large shares that shot the lights out. The share prices of the so-called Magnificent Seven grouping of Amazon, Apple, Alphabet, Meta, Microsoft, Nvidia, and Tesla were predominantly catapulted higher by the artificial intelligence hype this year. While this basket of 7 shares was up around 85% for the first 3 quarters of the year, the other 493 shares in the S&P 500 were down by a combined 10% in the year, leaving the overall index around 13% higher for that period. Such a narrow-based market advance brings the sustainability of ongoing equity market upside into question. As volatility in global fixed income markets have shown for some time now, there is a growing sense that global activity is losing momentum. With monetary policy working in long and variable lags, we are only starting to see the lagged effects of the 525 basis points of hikes already implemented in the US and United Kingdom and 450 basis points in the Eurozone at the time of filming. The expansion of central bank balance sheets through quantitative easing helped inflate asset prices in the past. So it is reasonable to expect that asset prices will face downward pressure as these balance sheets shrink. A tightening in global interest rates has brought monetary policy firmly into restrictive territory. This has increased households' and firms' interest payments. Moreover, consumers are seeking out more credit to supplement their income to support their rising living expenses. In the US, unlike other developed economies, excess savings from pandemic-related transfers are all but depleted, except for the top 20% of income earners who are keeping the economy afloat, or so says the latest Household Finances survey published by the Federal Reserve. Growth expectations for the US have softened, with consumers expected to contribute less to growth next year, given a reduction in savings, and a labor market which is slowing from a sprint to a more modest pace. The Bloomberg median consensus expectation for US growth next year slipped from 1.6% a year ago to 0.9%. Markets anticipate that growth should remain weak in Europe, as past inflation and interest rates bite further into economic activity. The Bloomberg median consensus projects that growth in the Eurozone will improve marginally from an expected 0.5% this year to 0.8% next year, the latter which has been revised lower from a projection of 1.8% a year ago. Contributing to the slowdown in global growth is the Chinese recovery, which has lost steam amid its post-pandemic reopening. Since the beginning of the year, the Bloomberg median consensus estimate on Chinese growth for 2023 has been scaled back from a peak of 5.7% at the start of the year to 5%, with next year's growth rate expected to slow to 4.5%. Additional downgrades are likely to follow suit, given tightened restrictions against China, sluggish demand in Europe, persistent weaknesses in the property sector, and subdued consumer confidence due to a lackluster performance in the equity market, as well as high youth unemployment. While the Chinese government reverted to familiar top-down stimulus measures, a more cautious approach was taken due to the concerns that the conventional levels of economic stimulus could exacerbate inefficiencies and disrupt the orderly deflation of debt bubbles in specific sectors. Despite policymakers' steadfast commitment to boost domestic sources of sustainable growth and reduce reliance on external demand, there has been a lag in policy implementation. Subdued inflationary pressures have become an additional source of worry regarding China's economic prospects in the recent months. Consumer prices experienced deflationary trends in July, sparking a comparison with Japan's deflationary spiral. However, core and services inflation, reflecting underlying trends, have consistently maintained a comfortable position in positive terrain. In our opinion, various factors mitigate the risk of China succumbing to a Japanese-style debt deflation scenario. In contrast to Japan in the 1990s, which was heavily reliant on the real estate sector, China has diversified its economic focus towards new energy markets and the digital economy. Japan's global export share plummeted from 8.5% in 1990 to only 3.5% in 2020, partly due to yen appreciation. In contrast, China commands a substantial 13% share of the global export market. During the 1990s, Japan experienced a significant surge in both equity and property prices. However, the ascent in China's asset prices has been far more gradual, suggesting that authorities still have a bit of leeway to deflate the bubble rather than witness a sudden burst. While Japan grappled with stimulating private sector lending in the 1990s, China possesses a state-owned financial system that ensures lending into the economy, averting systemic crises. The issue of China's aging population is a growing concern in financial markets. In 2021, 15% of China's population was 65 years or older, exceeding Japan's 13% in the early 1990s. Nonetheless, despite these demographics, a notable surplus of labor is still available in the Chinese economy, given the recorded 22% unemployment rate among the youth aged between 16 and 24. While China battles low inflation, much of the rest of the globe are still facing inflation rates in excess of central bank targets. Nevertheless, the likelihood of the major economies requiring significant rate hikes from here is lower, given the tangible evidence of earlier monetary policy tightening and given that the risks associated with inflation are currently more evenly poised. Though even if interest rates have yet to peak, future hikes should be less consequential for financial markets given the extent of rate tightening so far. That said, interest rate cuts are still seen to be some way off. Central banks are exercising caution in prematurely claiming victory in their efforts to rein in inflation. They are likely to sustain restrictive policies until inflation is consistently anchored closer to central bank targets. The Bank for International Settlements, or BIS, delves into the challenges confronting central banks in achieving the elusive last mile of disinflation. The BIS emphasizes that the latter stages of disinflation, characterized by positive but decelerating inflation, face hurdles such as waning base effects. Additionally, a late cycle surge in demand might ensue as real purchasing power improves amid slowing inflation and a rebound in nominal wages. Furthermore, mounting political pressure may compel central banks to ease interest rates as financial stresses start to accumulate over time. The initial surge in inflation triggered by supply chain disruptions, which appear to have subsided, has transformed supply chains into instruments of non-military leverage during political negotiations. Political trends and ideological differences are increasingly influencing global supply chain activity. Considering international relations between the world's two largest economies, the America First agenda, led by former President Donald Trump, accelerated the US's shift away from reliance on manufactured goods imports from China. Consequently, geopolitical relationships are now pivotal as nations strategically structure and diversify their supply chains. This is expected to significantly mold future trade and investment strategies on a more global scale. The expanding BRICS grouping, the African Union's inclusion into the G20, and a heightened focus on the global South underscore less developed and emerging nations' resolve to break free from Western influence and challenge the dominance of the US dollar. Nevertheless, Western powers remain influential, implying that nations need to adopt a more agile approach to foreign affairs. The emergence of geo-economic fragmentation, delineating the global economy into competing blocks poses a significant threat to emerging and developing economies. These countries, highly dependent on a globally integrated economy, foreign direct investment, and technological transfers, are particularly vulnerable. Hence, fostering multilateral cooperation becomes imperative to mitigate these adverse effects. While none of this implies that an economic disaster is looming, the era of the Goldilocks economic environment is likely coming to a close. The uncertainty regarding the impact of tighter monetary policy, coupled with persistent inflation concerns, more recently due to renewed conflict in the Middle East, raises a critical question. Has the policy tightening executed thus far been adequate to smoothly steer inflation back towards the target? Continued cost pressures or renewed signs of rising inflation expectations may necessitate central banks to keep policy rates elevated for longer than anticipated, potentially exposing financial vulnerabilities and keeping debt burdens high. This raises the risk of additional volatility, particularly for lower-income countries that are already grappling with significant debt financing challenges. In today's interconnected world, maintaining open and well-functioning financial markets with resilient supply chains are pivotal for long-term prosperity across advanced and emerging economies alike. As such, international cooperative efforts are crucial in addressing the looming risk of geoeconomic fragmentation, which threatens to disrupt supply chains, food security, and the clean energy transition. In the short term, prioritizing efforts to rebuild fiscal space and ensure debt sustainability would conserve resources for future policy needs. Better alignment of fiscal and monetary policies should reduce the pressure on central bank authorities to manage aggregate demand and inflation. Establishing reinforced and credible medium-term fiscal frameworks alongside clear guidance on spending and tax plans would aid in addressing these challenges. Lastly, we need to revitalize structural policy initiatives in order to enhance growth opportunities. This involves reducing barriers in both labor and product markets while improving skills development, ultimately fostering investment, productivity, labor force engagement, and promoting more inclusive growth. I thank you for your time.
Thank you, Sanisha. That was very insightful. Next is Nina Saad, our Head of Institutional Portfolio Solutions, who will talk about going global.
Thank you, Mike, and good day, everybody. Given that we can now invest almost half of our multi-asset portfolio offshore, holistic portfolio management and the integration between the local and global components of a portfolio has become increasingly important. When the regulations were relaxed last year, we approached the change with rigor and remained anchored in our OBR philosophy, where we place our client objectives at the center. Today, Harold from Robeco and I will spend time on our recent collaborations and how we at Momentum Investments are aligning local and global investments from a return, a risk, and an ESG perspective. Now, we have welcomed the regulatory increase in offshore exposure as it increases our opportunity set. There's a prospect of greater diversification benefits, and it allows for the improved ability to collaborate with our global partners to ensure holistic portfolio management to meaningfully integrate the value add. With South Africa being a mere 1% of the total global economy, offshore markets offer a myriad of different possible investment opportunities to choose from, and therefore represents the perfect way to diversify your portfolio of assets. Whilst these global opportunities have always existed, the potential impact it had on a South African Reg 28 portfolio was historically limited. Our regulatory offshore allowance was as low as 5% back in the 90s and ratcheted up and sat between 15 and 25% for some time, to now a significantly meaningful allocation of 45%. So with almost half of your portfolio now allowed to be invested outside of South Africa, there are a number of benefits of the expanded opportunity set. Diversification and protection from a weakening currency are probably the most important benefits. The expanded opportunity set includes exposure to different economies and global asset classes, different regions, industries, companies, and exchange rates. It now also gives one the opportunity to invest in a meaningful way into longer-term themes and growth opportunities, themes that ordinarily might not be available in the South African market. For example, we can access a meaningful direct allocation to biotechnology developments, AI, and the like in our client portfolios. Effective diversification is essential for investors, and offshore markets can offer just that. While our investment opportunity set has broadened, the global investment market can be a daunting place. The question around what and how to invest, given the myriad of opportunities available, therefore remains to be answered. Where we have identified a South African investment manager that has the capability and skill to successfully integrate global assets in their investment portfolio, we have afforded them the flexibility to do so. For example, we have recently given some of our local property and local fixed income managers the flexibility to include offshore investments in the South African mandate they manage for us. Now, we believe in breadth when it comes to research. Harnessing skill sets from various experts gives us the competitive advantage in delivering on our clients' objectives, whether it is performance delivery, risk management, innovation, and also staying abreast of global best practice. A collaborative approach to global investing does not mean committee-driven decision-making, but rather allows the ability to focus on research and innovation within each respective area of strength to support our portfolio managers on an ongoing basis. We believe we can extract meaningful benefits for our clients by partnering with a well-established global investment manager who is aligned to our OBR philosophy. There are a number of key pillars supporting our collaborative efforts in building robust client portfolios. Each have a very important role to play in our investment decision-making process. We at Momentum Outcomes-Based Solutions are accountable for the outcome of our clients' portfolios, and so it follows that we in SA own and drive the philosophical approach of portfolio construction, managing the overall client investment proposition and identifying asset classes and strategies, both locally and globally, that fit our clients' investment objectives. Furthermore, at Momentum Investments, our research hive has a dedicated focus on research, and our academic partnerships allow us to invest in academically grounded theories. Momentum Global Investment Management in the UK is an extension of the investment team in South Africa. Geographically, with their location in the UK, gives them the edge in scouting the globe for innovative solutions, trends, and ideas. In addition, our global investment partner, Robeco, gives us access to world-class research, strategies, and portfolio construction methodologies aligned to our overarching philosophy and best practice principles. So why Robeco as a global partner? The answer is simple. There is a strong alignment in Momentum Investments and Robeco's philosophical approach to investing. As a global asset manager, Robeco has a range of client-focused propositions in sustainable investing, quantitative, thematic, credit, and emerging market investing. Research lies at the heart of everything they do, with a pioneering but cautious approach that has been part of their heritage since their foundation in the Netherlands in 1929. Robeco has routinely integrated ESG across all of their investment processes. They are frontrunners in active ownership and continuously push the boundaries of impact investing. Similar to Momentum, their vision is to create wealth and well-being for clients, with a mission to enable their clients to achieve their financial and sustainability goals by providing superior investment returns and solutions. Robeco is an active asset manager with a long-term investment view. Fact-based, disciplined, and risk-controlled in everything they do, and with a strong research culture, Robeco has the ability to convert research into innovation. These, we believe, are important credentials and characteristics that rhyme perfectly with our approach at Momentum. Now, global investing can be implemented and managed in multiple different ways. We believe that the partnership approach, as part of the broader collaborative approach to investment research, makes sense for a couple of reasons. Often, the optimal or most robust investment opportunities are found through innovation and research collaboration, which sometimes is missed by internally focused investment managers. Research collaboration widens the breadth and depth of research in the areas of portfolio construction and portfolio design, risk management and day-to-day portfolio management decisions and implementation. Global best practice remains top of mind, and through the lens of a global asset manager, it remains priority and ensures that world-leading insights from all different perspectives in the investment world are applied to investment portfolios of South African investors. And then, very important, is the aspect of costs. Global investment strategies have traditionally been the most expensive component of a South African multi-asset class portfolio. The pressure to reduce fees remains, so the focus on the cost of managing global assets is intensified. A partnership agreement allows for the benefit of economies of scale to be passed on to clients. With a partnership, it truly gives you the opportunity to research, identify, and create the optimal global investment strategy aligned to a client goal from multiple perspectives. Often, investment managers that outsource assets to an external global provider would be fund takers. Within a partnership arrangement, it gives you the ability to design and co-create investment strategies that are directly aligned to the client's objectives, as we have recently done in our integrated systematic equity solution for our South African client portfolios. The principle we applied in designing the integrated equity portfolio is to have consistent exposures to shares with common characteristics. These are the commonly identified style factors: value, momentum, and quality. The excess returns that you get from portfolios built around these characteristics are the risk premia or factor premia that we are looking to capture. They provide the basis for systematically extracting superior returns relative to the benchmark over time. The returns of the individual factor premium can and do vary through time and markets, which talks to the multi-factor approach to diversify away the risk that a single style factor presents. In the recent study we did with Robeco, we looked at the patterns of relative returns for these style factor premia for both South Africa and globally. Importantly, we used common definitions for the factors across local and global stocks. We found that while the style factor premia exist and can be exploited in both our market and the globe, the expected levels of outperformance and the patterns of these relative returns varied between South Africa and the globe. More specifically, we found that the momentum style factor in South Africa had a higher expected return than its global counterpart, while the quality style factor showed the opposite. The identification of these differences allowed us to build an integrated equity solution for South African investors that favors local momentum as a style over global momentum, yet tilts the portfolio to global quality stocks over local quality stocks. Taking an integrated perspective on these factors, the combined equity solution is superior to simply combining the individual local and global style factor premias. Now, over and above the integration of the factor premia was the ESG dimension. We looked at the relative efficacy of achieving ESG-linked enhancements for our equity portfolios in local and global equity markets. These included managing carbon emissions, social impacts, and governance improvements relative to the benchmark. Our work clearly showed that the breadth of the global equity markets makes the implementation of these ESG goals far more effective over there when compared to South Africa. As a result, we have been able to credibly commit to an overall improvement in ESG scores by setting higher targets on the global component than that of the local component. Local and global asset classes should no longer be seen as separate and independent. Therefore, a well-thought-through, integrated approach to investing, taking into account all elements of risk and potential return from all aspects of the portfolio, should no longer be just a nice-to-have in client portfolios. A structured and properly thought-through research framework and collaboration on strategic initiatives allows for ongoing innovation at a greater scale, whilst at the same time enriching the investment debate, all working towards the same goal of enhancing financial wellness for our clients. Sustainability and responsible investing resonate deeply with Momentum Investments and Robeco, and the partnership will enable Momentum Investments to further improve the environmental, social, and governance profile and carbon footprint of our portfolios. I hope this adds a bit more color to our approach to global investing. In summary, what we aim to achieve through a global investment partnership is risk-managed, long-term sustainable growth opportunities at the right costs through the lens of a client objective. Harold will shed some more light on what all of this means from a practical perspective, and some more detail on the integrated systematic equity solution we, as partners, co-created. Thanks, Harold.
Thank you, Nina, for this very kind introduction, and hello to all our virtual guests today. I'm Harald Lohre from Robeco. I'm part of the Quant Equity Research team, which is responsible for essentially advancing the investment models that are driving our quant equities capabilities. The research team is a 20-strong research team combining various technical backgrounds. Lots of my colleagues actually do keep close ties to academia, and I'm actually no different. As you can see on the slide, I'm also affiliated to Lancaster University, so my academic home is in the north of England. Today, I'm speaking to you from our headquarters in Rotterdam, and if we were to hold this in-house, of course, you'd get a chance to have this beautiful view over the Erasmus Bridge. But I thought, like, since this is online, this is virtual, this is a webinar, I can actually switch gears from a Dutch autumn to a South African summer. So let's quickly do that. And I guess all of you, you're gonna have been here at some stage to enjoy this magnificent view. Some 5 years ago, I was actually very close to also enjoying this. I was somewhere down there in the financial district in one of those Cape Town towers, essentially trying to make the audience excited about factor investing. And yeah, today is not going to be any different. So I'm trying to entice you about factor investing. Nina has actually perfectly set the stage about what we're gonna do. And it's for me to actually bring this collaboration between Robeco and Momentum to life. So let's do just that. For you to get a sense, what is our journey for today? It's essentially 3 parts. So first, essentially showcasing the Robeco capabilities. So we are well known for quant investing, factor investing, but we're also a pioneer in sustainability. So effectively, part 1 is going to bring this together. We'll touch upon the origins of factor investing. We'll speak about how we at Robeco advance the factor definitions underlying these investment capabilities, but also how we bring sustainability within our investment solutions. I guess the most interesting part of this one is really how do we, Robeco and Momentum, have collaborated in the past to bring this integrated equity portfolio solution to life. So wanted to give you like a few of the key insights that we've been having on our joint journey. So effectively looking into factor investing in South Africa. Does it work? And what about sustainability if it comes to South African investments? And effectively, how can we get together, and what can both sides learn from each other? How can we essentially enrich the factor definitions that are in place for South African equity factor investments at Momentum? And whilst this is all, if you will, theory and concepts, the proof of the pudding is in the eating. And that's going to be the last part of this presentation, effectively looking into this integrated global equity factor portfolio. How do we actually bring together these two components, so the South African equity factor investments together with a global factor portfolio, and how do we make them interact in a meaningful way? And I'll be showcasing a few of the salient portfolio characteristics that we observe and the resulting sustainability profile. So without any further ado, let's jump right into it. First part, sustainable factor investing. If you think about the origins of factor investing, you would probably have to travel like 60 years back in time. And that was actually a fairly easy world, because factor investing at that time would just be a one-factor investment world. And you all know the factor, the market portfolio. Sharp, Lindner, Moss, and Trenner, many works kind of around this one factor to unite them all. But actually, it turned out this factor would not unite them all. So looking further, if you just take like the very well-known value investing style, documented 1977 in the academic literature, but of course, this has been practiced for much, much longer, is one of the factors if you buy cheap assets versus expensive ones, where you find like, this is not explained by the CAPM. So it's actually refuting the CAPM. And this kind of brought about a search for many, many factors that would actually do just that and hopefully add over and above the CAPM, and thus adding over and above a plain market factor investment. And I guess you know the antagonistic player of value, that's Momentum. So Momentum, not the firm, Momentum, the factor, where you just buy winners, recent price winners, and you sell or you shy away from recent price losers. And a bit further down in the 90s, there was another concept, the quality concept established, which is essentially one is looking for companies with a strong balance sheet, so of a healthy financial strength. And these form like, if you will, three salient factor characteristics that are meaningful to diversify across. So typically, we would not go for one of those, but rather bring them together to smoothen out the return profile, which is what we then would call multi-factor investing. As you can see, this sort of stops 25 years ago, but time has progressed, and you can imagine there have been lots of PhD students, and I was no different, trying to make their name, bring up a new factor, or maybe refuting existing ones. But if many people do this in this competitive space, and it's not just competitive in investing, it's also competitive in academics, you actually end up with lots of factors, which is shown by the number of publications in these charts, in the big journals, in the big finance journals, documenting, hey, look at these characteristics. This is also adding over and above this one. So in the end, at the time being, we're looking at hundreds of factors that could be deemed relevant, that could be of interest. And we've sort of ended up with this zoo of factors, how it's often called. So the question is a bit, how do we actually navigate this factor zoo? And this is our daily bread and butter, if you will. So what we have to look when looking at these contenders, at these factors, it's a bit about separating the wheat from the chaff, or and to stay in the factor zoo terminology, it's separating sheep factors from goat factors. So what are we looking for in these factors? On this slide, you see effectively 5 characteristics that we need to see. First of all, of course, should be performing. So some meaningful risk-adjusted return pattern should show up for us to have interest in the first place. This pattern should be robust. It should be proven. It should show in different time periods. It should show across geographies. It should stand our researchers trying to shoot holes in it, so to make really, really robust. Of course, these investigations can only be done with hindsight. We are investing with a forward-looking perspective. So what you want to have is persistency, right? We need to have a strong rationale that this factor is going to be there going forward and that it's not arbitraged away, which closely ties to the fourth dimension. It needs to be explainable. So we need to have a strong economic rationale as to why a pattern, a return pattern in the data has worked in the past and is actually assumed to also perform in the future. And lastly, and that's probably the typical thing where lots of these hundreds of factors actually fail is they're not executable. So you have to make sure that what you find is not just a statistical fluke, that it's not just on paper, but that it can really be translated into portfolio performance so that it survives trading costs and other market frictions that would eat into your portfolio return. So how is that with the salient factor dimensions, factor styles we've laid out earlier, value, momentum, quality? Historically, even for generic, so the academic simple definitions that people would use, this is actually the fact. And you see, I mean, the market, that's roughly in the middle. Of course, these portfolios they need to be somewhat unique. I mean, if they have nice return patterns, but in a way measure the same thing, that's not of use. But here you can clearly see through a risk return lens, these are different. So you have a more, say, more risky value and momentum styles, and obviously momentum is the riskiest one, but also a bit more defensive quality type of style. And these elements, they work together well in terms of diversifying and helping you to come up with a fairly smooth risk return profile over time. So this is the academic exercise. So we're kind of taking this academic evidence to test. But then again, we are not, we can't rest on our laurels, right? We can't use these academic definitions starting in the 90s and hope for them to last forever. But a big part of our job is to essentially advance the underlying factor definitions, because markets are adaptive and definitions change. So think of value. What was value like in the 70s, 80s is quite different from what is value today, where you have lots of companies that essentially where their value is mostly intangible. So think of Robeco, a researcher. I mean, that's very intangible because it's all in our heads. So you need to take that into account to come up with a proper value metric. And maybe just to share another philosophy, how we approach these, how do we advance and think about these factors, is essentially starting from the academic definition. Is there something risky in it, some unrewarded risks that we can take out? So if you just think of the very first factor, value, lots of people thought like, this is value premium that's crucially driven by distressed stocks. So researchers at Robeco actually checked that, and turns out, no, that's not the explanation, because if you take out distressed stocks from the universe, your value effect actually gets a bit larger, and you have much less risk because you're taking out distressed stocks. So in that sense, improving the risk return profile. Similar for momentum. If you look at the academic momentum factor, it has severe drawdowns. A phenomenon that's actually called in the literature, it's called momentum crashes. I mean, that says all. I think like around the March 09 drawdown of momentum, we saw like 80% drawdown in the long short factor of the academic momentum factor. So this is huge. So you need to think about how can you come up with risk controlled versions of momentum. And Robeco researchers have thought about a way to alleviate that problem by just taking out the market, the market-driven risk in momentum. So kind of focusing on the company-specific momentum and just focusing the metric for the momentum score on this one. So this residual momentum of a given stock. And this residual momentum factor as a whole actually turns out to have just the same expected return or historical return as the academic momentum factor, but at a much reduced risk, meaning the risk-adjusted return is much better. So I think that gives some good insight as to how we think about advancing factor definitions, make sure that we're not taking unrewarded risks, and make sure that the definitions stay relevant. Something else I wanted to point out here is also, these distress risks, these momentum crash risks, we can kind of see historically, but there's one big risk that actually so far has failed to materialize in historical data, which is sustainability risks. So if you think of these factors, especially value is by design, if you think about what value is usually going for, it's going for asset-heavy industries and stocks. So meaning value comes with quite a large carbon footprint. And that, of course, if you think about these sustainability risks at some stage materializing, maybe I want to do something about this looking forward, right? And that's exactly what we do to the definition of our value factor. Is in building the score, we are residualizing, so kind of taking out this tiltedness towards high carbon emissions, but also towards high water usage or high waste generation. So taking out these things that make it a quite unsustainable factor per se. So we neutralize it so that we don't have these tilts right from the get-go. So kind of shooting for high value returns doesn't mean, oh, I'm implicitly shooting for an unsustainable portfolio, but that it's neutral. And that, of course, puts us in a much better position when it comes to bringing in more sustainability consideration. And we'll actually see how that is going to pan out as part of the integrated global equity factor portfolio. So let's move on. Sustainability, speaking about that. Being at Robeco and Robeco being at the forefront of all things sustainability research is actually quite a hard task to kind of put it all on one slide, but that's exactly what I'm gonna try doing just now. So if I were only to show you one slide for Robeco and sustainability and how we go about this in terms of integrating it into our quant portfolios, this is the slide. So let's get a go. Obviously, it's all coming in green. If I travel back like 20 years, and actually that's kind of where my career in investment management started out, as a quant, you've been doing it from day one in terms of accounting for sustainability, because at that time it was quite easy. So clients, churches, endowments, they would provide you with an exclusion list of companies they would not want to be investing in. Think of tobacco, think of cluster ammunition, these type of buzzwords, you would want to have them excluded. As a quant, you just shrink your universe and you go with it. And obviously that's something that we still do at Robeco based on a Robeco specific policy, or if the client wants to have a different client specific list, we can also do. If you think further, excluding is one thing, but then of course you'd also want to reach certain targets, sort of a best-in-class approach where you're shooting for a certain carbon emission reduction, where you're shooting for meeting certain ESG scores or targets in your portfolio construction. And of course, this can be easily integrated in a quantitative approach. What is a bit more contentious, if you will, is ideally I can bake the sustainability consideration into the construction of my alpha factors. So just as we've seen with the value factor, where we are kind of taking it out, if you were able to take it one step further, where you are looking at company characteristics that would actually be associated to sustainability, but also be associated with future returns, i.e. where you have a financial materiality and sustainable utility materiality, and they kind of go together hand in hand, i.e. when you are shooting for this very factor, you implicitly improve in your sustainability profile. And this is actually going to be looked into on the following slide. But before we're getting there, of course, a large and important consideration is addressing the environmental footprint, i.e. bringing down the overall carbon emissions associated with the portfolio, but also looking at water use and waste generation. And that is effectively, if you think of the two earlier points, ESG as a factor for one, but also the sustainability integration in terms of constraints. This is just the avenue to choose when it comes to carbon footprint. So these four are pretty much, I mean, that's where, as a quant, I feel very comfortable. But if you take a step back and think about it, I mean, exclusions, if you divest, it's identical to disengaging, right? So you are actually leaving the critical companies to someone else, and there is actually no way for you to essentially lead to change. And in that sense, I'm actually very, very happy to be at Robeco with such a strong sustainability team, which brings a lot of engagement and voting experts that could then essentially step in and call out certain companies and really bring in change and call out issues. Something that, if you think about it as a quant, I mean, I'm very uncomfortable with these type of things. We're always avoiding difficult conversations. These colleagues actually, I mean, they get energy from these conversations. So it's actually a blessing that we as quants can build on their expertise and really trying to leverage the whole opportunity set, if you will, of sustainable investment solutions. So that's great. But if it comes to bringing all of this together in terms of a client-specific setup, I mean, that's where the quant is back in the game. So that's, I think, where we excel, is essentially customizing to your needs and not just providing you something from off the shelf. And if it comes to sustainability, it's almost always, it's not off the shelf. So it's still so much in flux that people have their own thoughts, and that's actually a very good thing. I mean, effectively, it's aligning your portfolio with your values, with your mindset and your outlook. So it's almost a requirement that you're able to customize your mandate, and that's just what we can deliver. So before we are looking into that solution, finding alpha and sustainability, because that's such a contentious topic, I thought it's worthwhile highlighting. The first item on the upper left, I mean, we've already discussed. So yes, you can decarbonize your value factor and thus by design reduce your carbon footprint. But what about these E, S, and G dimensions? We kind of know if you lump them all together, so you take an aggregate score, depending on what provider you ask, you get many different answers. So you actually have to kind of look under the hood and synthesize certain dimensions and look how it goes. And I've brought like 3 examples. So one for the E, one for the S, and one for the G, how this actually can work out. So let's start in the lower right, an example for E. So E is for environmental. So yet another greenish factor, if you will. What we've looked at in quant research is, if you look at how companies, how efficient are they operating in terms of their CO2 emissions? So are they like really, is it prudent and efficient? Or are they like really not looking after this and truly inefficient? What we see is that this actually has an effect on the bottom line. So if they are sort of loosely with their carbon efficiency, it also reflects in operational efficiency, and that has an effect on future returns. So this is actually helpful to look at. And actually turns out it's not just how efficient your carbon emissions are, it's also about your water usage, it's also about your waste generation. So if you show prudencies in these actions, it typically on average reflects in your business behavior and thus future company performance. So this is something you can look for the E dimension. In between E and G, there's S, and S, that's for social. I would think that social, that's an often overlooked dimension of ESG, but that's really an important one. What we've brought up here as an example is if you look at your employees, so they're like platforms called Glassdoor, where you essentially as an employee can go and rate your company. And what we found is that effectively, more happy employees, that leads also to higher future returns for the company. And I vividly recall when this was discussed in our research meeting, the responsible researcher, he would have like his first slide would show a cow. And the headline was, "Happy cows give more milk." And that's just what we see taking effect with us as well. So that would cover for the social dimension in ESG. And lastly, G, governance. Something we've looked at is at listed companies, is the founder still around? Now you might wonder, is that a good thing or is it a bad thing? Actually, it's a very good thing if the founder is still around, because founder-led firms we found to typically exhibit longer-term growth, which is then also reflected in them outperforming their peers in the future. So that's effectively different angles, how you can bring in sustainability already in the process of forecasting stock returns, and thus implicitly improving the sustainability profile and making it less necessary for all of these constraints to sort of do the job after you've formed your maximum return portfolio, right? So with that in mind, let's see how we've brought this knowledge base, if you will, together with Momentum to actually produce Robeco research with Momentum. And obviously, pun intended here. Let's see. Effectively, I want to highlight 3 dimensions. So for one, of course, factor investing in South Africa, does it work? So effectively, what we've done is replicate existing factor evidence based on what Momentum has provided, and then see, how can we actually help advancing the Momentum factor definitions based on the knowledge I've just shared, and see if these bring effective enhancements for the South African equity factor offering. So that's one. The other bit, of course, is sustainability. How does that look for in South Africa? But also a lot of knowledge sharing from our sustainability investment teams to kind of get on the same level playing field, if you will. And of course, the main purpose of this exercise was to investigate an optimally integrated overall portfolio that would take the South African factor portfolio and complement it optimally by a global factor portfolio, such that overall they are kind of act as meaningfully complements. And this is what we're gonna dive into. And let's first look at, if it doesn't work, if it didn't work in the South African market, I guess we wouldn't have this webinar. But it turns out actually the South African market is peculiar, but it lends itself sort of naturally to also see these factor concepts work. And that, of course, is confirmation, right? We want to see it work across geographies. That's great. What you see here in blue, that's effectively the academic factor evidence for South Africa that we've built. But then thinking about, okay, how can we enrich this? And of course, using the same sort of ideas, bring in decarbonized value for Momentum. How about residualizing Momentum, see how that diversifies the concept. And quality, you see, quality is a bit a laggard here, right, in terms of academic factor performance. So let's bring in our thinking, where our thinking is we try to have metrics that help forecasting the earnings, and thus have like strong meaning for those. We find them also to have more power for explaining future returns. So there is investments, there is accruals, and profitability. If we do that, we have these orange bars. And being at a Dutch company, all the good things are in orange. So you see these factors kind of getting slight boost, but especially quality is benefiting a lot from enhancing factor definitions. Still, Momentum sort of stands out. So this is still the big return winner, if you will. So we should sort of, in our construction later on, have that reflected, right? If South African equity market is sort of a pretty much a Momentum market, we should not be blind to that evidence, right? But how does this compare to now global factors? Because in the end, this whole integration exercise is about marrying the two, South African equity factors and global equity factors. So on the right-hand side, we see just that. It's the same scale. So we're going from 0 to 10% return. mean, from a distance, you can kind of see, yeah, it's positive. That's great. It's with the exception of momentum, I'd say roughly on par. So you see like the enhanced factor definitions in orange is pretty much on par. So 4.8% for quality, and the highest one here historically is value, 5.7%, momentum somewhere in the middle. So you would think from a distance, yeah, maybe if these are sort of our expected return forecasts for the factors, be like roughly equally balanced across those. And maybe here in the South African bit, you want to be a bit higher on momentum. So let's keep that in mind while we move ahead, because before we can go there, of course, we have a sustainability objective in mind, and this, of course, is quite different. I mean, here some high-level statistics, and I guess the key message is to this audience, it's stating the obvious. South Africa is a carbon-intensive market, and this especially shows if we look at CO2 emissions per GDP. So then it's actually the leader in a negative sense, if you will. I mean, this is what we know, but the big question is, can we do something about this? And especially, what does it mean for the factors that we're investigating? And here you see the carbon footprint for the different factor concepts. So quality, I mean, we've seen it before. So there we have some ESG factors, alpha factors being part of it, and quality by design as a defensive factor. It's known to have a less high carbon footprint. But yeah, you see value, what we've been talking before, the asset-heavy industries. I mean, this is the largest footprint we observe. But yeah, what can we do about this? This decarbonizing value brings us to this greenish bar in the middle. So actually, we can come on par at least with the momentum factor to have something sort of neutralized. And of course, in the end, what we wish to do is bring these three factors on the left together. So if you do that without neutralizing, you get this first multi-factor bar, yeah, which is having like a higher footprint than the market. But if you were to use the decarbonized value in this, you can see you go down and actually you are on par with the market, which is a neat thing to begin with. But still, we have to keep in mind that this market, the South African market, is pretty high to begin with. So we need to think about how can we actually further improve in terms of the global solution. So it might be worthwhile to think about, if you will, overshooting on the global factor portfolio to sort of compensate a bit for this hefty footprint that we have for the South African portfolio. So let's look further into that. But first, we need to show like what was the outcome from this optimal integration exercise of these different factors. And yeah, you sort of see the ultimate factor weights here with the rationale on the right hand side. So you'd wish to participate in this larger momentum premium in the South African market, and in that sense, having in mind, maybe we need to compensate a bit of the sustainability concern. Maybe you want to bump up quality on the global level, which is what we do in relative terms. And if for some in the audience now this sort of looks familiar, yeah, you're spot on. You've been served this before by Nina, but she's been working with a donut. So here we go again. Here's the donut, and I think what this donut nicely shows is that on a global level, we're actually shooting for a very balanced profile across value, momentum, and quality. But under the hood, we've made certain calibration and precautions so that yeah, all requirements are fulfilled in the end, especially when it comes to the sustainability requirements. So that concludes the second part, but you might still think, yeah, this is all about theory. How do we actually put it into practice? So how do we bring this concept to life? And for this, let me quickly show you yeah, some of the portfolio settings, the overall setup, and how we go about this. And if you think about the setup, what should be the guiding light is you want to have high diversification. You want to be diversified across these factors to effectively be to harvest the associated premium. That's one. But for that to happen, to have a high likelihood of that happening, you want to be diversified in terms of the underlying stocks as well. So you can't be very concentrated. This is not a high conviction portfolio on single stocks. It's a high conviction portfolio on these few factors. And for having that, we need many stocks. So the portfolio construction comes with quite a few constraints, not just on stock level, but also on country, on regions, on sectors, on industry groups, to make sure that we are fully focused on getting the factor exposures right. That's one, but of course there are other things that we need to deal with, and that is, of course, for one, you have these alpha forecasts, the return forecasts for your stocks that you want to buy because they have attractive factor characteristics. But on the other hand, I mean, these stocks, if you want to buy, it's costly, so there's going to be friction. So in portfolio optimization, we bring in the transaction cost considerations and make sure that this the risk-return trade-off also makes sense after costs, and that we ultimately not have high turnover, and then it's just back and forth, and the only one who's happy is the investment broker. No, we are shooting for a high net return after costs, obviously. That's sort of the overall quant setup. What is important here is, of course, what about sustainability? So what are like the underlying sustainability goals of this mandate? And you see, for one, we are shooting for having 10% better ESG rating as measured by Sustainalytics than the reference index. So that's one. But we're also shooting for a 50% better environmental footprint. So reducing carbon emissions, the water usage, but also the waste generation. And 50%, that's quite something. And that is, here we're talking about the global portfolio that is used to compensate for the footprint of the South African portfolio. So that's why we're seeing these numbers here. So that it's on the overall level meaningfully in line. Of course, SDG is something I haven't touched upon so far. Of course, that's also Robeco has actually made open access our SDG framework. SDG is shorthand for Sustainable Development Goals from the UN. We have 17 of those, and I know many of those, and I guess the same applies to you. But I'm having trouble like going from 1 to 17. I don't know the numbers, but actually SDG 5 I can do very well, because that's about gender equality. And I have 4 daughters, and luckily my wife is still around. So 5 females at home, so it's very easy for me to remember SDG 5. But let's not get carried away by that. Of course, we also have to bring this to life on an ongoing basis, and that's effectively right-hand side. So 3 very simple things that we need to do is on a continuous basis, because if you think about it, unlike, say, sector definition or a country definition, the factor assignment is something, it's not going to be forever. So you can be a value stock at one point in time, you can be a momentum stock at another point, and you can be quality. And of course, you're always sort of a mixture of all of these factor exposures. So in that sense, that's dynamic. So we need to kind of constantly have the targeted factor exposure. We need to constantly refresh the scores and refresh the portfolio. The frequency with which we do it is monthly. So that's giving us just a good trade-off of the horizon of the signals we're using, and making sure that the factor exposures are always as fresh as we need it to participate in the premia after transaction cost. And of course, this whole process, this whole loop, we need to run the models, we need to run the optimization, we need to execute it, and of course, we need to monitor it, performance-wise, risk-wise, and this goes on and on. So that's what a quant does. You are what you keep on repeating on doing. And this is what gives us the exposure to factors and the premia over the mid to long term. How does it look for the integrated global equity portfolio? So from a factor investing perspective, we'd like to see 3 things. Are we getting the 3 factors? Value, momentum, quality. So let's just check for the characteristics of the resulting portfolio vis-a-vis the MSCI World Index. So for value, we see, yeah, check, we did it. Price to earnings, lower than for the MSCI World. That's what we want to see. Also, price to book, that's lower. That's just what a value portfolio would have. Momentum, we also see we have stronger momentum characteristics. So residual momentum for the portfolio is higher than for that of the MSCI World Index. Same for the earnings revisions. So we see percentage net positive in terms of upward revisions, close to 70%, whilst for the index it's just 58%. So that's also well achieved. And lastly, we also see higher quality companies in the portfolio relative to the index. So this has worked out nicely. This is what we want to keep in check at all times. This is our main target, but of course it's also sustainability. It's front and center. Are we meeting the targets we've set out in the portfolio settings? So let's check them one by one. So here you see us checking the 10% improvement on the ESG risk rating. So you see the benchmark 21.42. And this is, I think, almost exactly reduced by 10% to 19.26. So that's worked out nicely. If we check the second bit, the 50% improvement, and that's way larger, right? Are we getting there? Actually, yes, we're getting there quite nicely, sometimes overshooting the target. So even better than we kind of set our minimum bear assumption. That's great. And thirdly, we have the SDGs, of course, and we also here see we are having a higher percentage of positive scoring companies based on the SDGs. So in that sense, just looking at the current snapshot of this model portfolio, mission accomplished. That's very good to see. And now we just have to consistently follow this process month by month, and effectively enjoy medium to long term the associated premia with this overall process, both coming from South African equity factors and complemented by the exposure to global equity factors. So wrapping it up, essentially I want to leave you with three key messages today. One is Robeco is advancing the frontier of factor investing with sustainability considerations front and center. Robeco and Momentum have partnered to advance the creation of optimized and customized portfolio solution. And we've seen the integrated global equity portfolio. It allows for harvesting the proven equity factors, both in South Africa, but also beyond, whilst targeting improved sustainability outcomes. Thanks a lot for your attention.
Thank you, Harald. Mohamed Sibta will now give an update on the factor portfolio positioning. He will provide a summary on the key factors that have affected asset classes returns in 2023 and give insight to some of the portfolio actions during the year.
Thank you, Mike, and good day, everyone. Thank you again for attending today's session. In this section, I will provide a high-level summary of the economic backdrop, asset class returns to September 2023, and talk through our portfolio positioning given asset class valuations, investor sentiment, and potential risks. There's been a number of economic and market-related news during the course of the year, but we think that probably the three most important and relevant factors have been 1. Global inflation, 2. Interest rates, 3. Concerns around global growth. So we start off with inflation. While inflation has moderated and come off from the highs we saw during 2022, it still remains in most cases above respective central banks' target rates. As an example, US inflation reduced from the 8 and 9% prints we saw in the tail end of 2022 to around 3.5% to 4% in the past few months. Inflation has definitely proven to be sticky and poses a real dilemma for the Fed, given that the target is getting this down to 2%. These higher than inflation numbers have subsequently resulted in interest rate hikes for the most part of 2023, and short-term interest rates in most countries are now at the highest levels since the financial crisis period. These higher rates and uncertainty of whether we are at the end of the rate hiking cycle have not only resulted in market volatility, but have also raised questions and concerns regarding economic growth and whether these aggressive rate hikes could possibly lead to a recession. Thus far, economies, companies, and consumers have been resilient, and economic data have surprised on the upside. Recent IMF growth projections are still somewhat positive, as it maintains a global growth forecast of 3% for the 2023 calendar year and has a similar number for 2024. However, there are genuine concerns by many investment managers and economists that if rates remain at these high levels for a prolonged period, it could potentially result in lower growth in 2024. 2023 has been another interesting year for markets. The market started the year on a positive note, posting decent returns to around June. However, the reality of higher rates, coupled with concerns around valuations and future earnings, resulted in a disappointing third quarter for equity markets. Higher interest rates have also affected bond and property returns in 2023. If we look at our local equity market, this has been flat to the end of September. Resource shares in particular faced a challenging environment on the back of lower commodity prices. The resi sector returned negative 15% for the period ending September. Financial shares fared slightly better with a return of 6.8%, with the life assurance sector being a strong contributor to these returns as earnings improved after 2 difficult years of COVID claims. Banking shares were also positive, but came off their recent 2023 highs. Concerns around loan growth and high levels of consumer debt affected returns recently. The industrial sector was a top performer with a return of 10%, but the rand hedges like Naspers, Richemont, and ABI InBev have led these gains, while local shares like our retailers and mobile operators have underperformed yet again. Load shedding, higher interest rates, and just a general negative sentiment towards South Africa have explained most of this. SA equity returns were affected by large foreign selling. RMB estimate that the cumulative market outflow from SA equity and bonds for the first 9 months of the year now sits at 427 billion rand, while for the last 12 months, this amounts to a staggering 510 billion rand. SA bond yields followed global rates higher. This, together with concerns around SA's fiscal metrics, were a headwind for the asset class. Global asset class returns have benefited from rand weakness. Global equity markets in dollar terms are up 9%, with developed markets outperforming emerging markets. Within developed markets, the US equity was up 11.5%, but this return was driven by the so-called Magnificent Seven stocks. The Japanese market continues to post solid gains and contributed to the index returns. Global bonds in US dollar terms returned a negative 2.7% as yields have ticked up higher. We'll now talk about our portfolio positioning and some of our asset class preferences. So during the course of 2023, we transitioned our portfolios to the revised asset allocation. We made mention of this at the April webinar. The benchmarks were officially changed on the 1st of July 2023. So if you look at now the actual portfolio positioning, we still retain a healthy allocation to local equity and global equity across our portfolio ranges. We think local equity in particular has potential to deliver decent inflation outperforming returns in the next 3 to 5 years. SA equity is still trading at a discount to its long-term averages and is also cheaper on a PE basis than most developed markets. We are acutely aware of the negative sentiment towards SA, but we still think investors are being compensated for these risks. It is also worth noting that a large number of companies listed on the JSE derive most of their revenues offshore and have very little exposure to the SA economy. One of the more important changes in the equity portfolio is that we now have an underweight position to resources after being overweight for almost 3 years. So our preference for global equity over global property is based on better risk-adjusted returns. We have a 25% allocation to IT, 20% allocation to consumer discretionary, and a 15% exposure to financials within our global equity building block. We are still comfortable with the regional, style, and sector allocation, given the global backdrop and valuations. Within SA fixed income, we have increased our cash exposure as interest rates increase to very attractive levels. We still have a decent allocation to SA nominal bonds as they offer great inflation outperforming returns. However, we have not increased this allocation despite the attractive rates, as we still have concerns around possible increased issuance. We have continued to add to global bonds and global cash, as yields are very attractive, and these asset classes will provide greater downside protection to the portfolio in a risk-off period. And our negative view on local and global property is based on the respective fundamentals as well as from a relative asset class valuation. We have reduced the global property underweight as valuations have improved. We once again thank our clients for entrusting us with their members' retirement savings. 2023 has been a challenging year to generate inflation-beating returns, but we have managed to deliver positive returns for the 9 months to September. As always, our portfolios are well diversified across asset classes and strategies, and we are confident that our portfolios will be able to navigate through market volatility and deliver on their respective long-term objectives. Thank you.
Thank you, Mo. Mike Atsett, our Chief Investment Officer, will now summarize the webinar, as well as the key themes and focus areas the investment team is considering. He will also touch briefly on how the investment team is thinking about the two-pot system.
Thank you, Michael, and thank you, audience, for joining us for the last edition of Mindful Moments for 2023. In this version of the Moments, we unpacked two very important themes. Sanisha started talking about the economic resilience in the economy, and how it has surprised all of us, but that it might be too early to celebrate that the worst is over. There are some lagged indicators that there could still be a lot of risk in the system, and there are some headwinds on the horizon. Another big theme that we spoke about today was the importance of global investments, and with the relaxation of exchange control, how we need to integrate the local and global part of the portfolios. Nina spent a little bit of time unpacking the portfolio construction view, the high-level view, in terms of how we align factors, how we implement and integrate ESG between the local and global factors, before Harold went into a deeper dive in terms of what exactly Robeco, our global partner, does in the portfolios, how they manage the various factors, the value, momentum, and quality factors, and also how they integrate ESG and decarbonization in their portfolios. After Harold, Mo gave us an update on what's happening in the investment portfolios and the way he's thinking about managing the current volatile environment. He's seen a lot of volatility in the market, but there's good valuation in parts of the market. So local equities have good valuation, global and local cash is also giving good returns. So there's a good bank of potential returns into the future, but it may take some time for that to realize. On the neutral side, he was neutral towards local bonds and global bonds, as well as global equity. So although they are representing much better value, there are still some risks in the system as we wait for the interest rate cycle to roll over and for a clearer trajectory on the retracement of inflation going forwards. And he also indicated his negative view on local and global equity. So that was it from a portfolio and themes perspective. The other aspect that I did want to spend a moment talking about was the implications of the two-pot system. We are not exactly sure the full form that the two-pot system will take, as the regulation still needs to be finalized. But what we are aware of is that early next year, there will be a need for additional liquidity in portfolios as clients have access to a portion of the fund. The exact date and the exact quantum still needs to be determined, and we're waiting for the finalization of regulation. But thus far, it looks like it's potentially up to 25,000 Rand accessible in a savings pot for investors, as well as the timelines likely seem to be around March of next year. Although there may be potential for the timeline to adjust a little bit, although I don't anticipate it to adjust much, as there is an election coming up, and there will be pressure from government to give investors money and get money into the economy. Now, what are we doing from a portfolio management perspective? We're working closely with our administrators to anticipate the potential size of disinvestments that will come about as a consequence of the two-part implementation. And the portfolio managers are not only sizing them, but looking and making sure that there will be sufficient liquidity in the portfolios for the time when investors need to draw on them. So once again, thank you very much for joining us in this final version of Mindful Moments for 2023. If I do not see you or speak to you again, have a blessed festive season, get some rest and travel safely, and we'll see you in the new year. Thank you.
Thank you, everyone. This was very valuable and showcased the important role that global investments have in a portfolio and why properly integrated local and global asset classes is such an important issue. Managing a multi-asset portfolio in a dynamic and volatile environment requires a steady and knowledgeable hands, and we got to hear from some of the key investment people at Momentum Investments. Please remember to watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of November and still receive your CPD points. The CPD certificate will be emailed to you during December 2023. Thank you.